Is this tech giant riding just an unstoppable wave to new all-time highs? Or are eager retail traders walking right into a massive, heavily disguised valuation trap?
Yeah, that really is the ultimate question right now in the market. We're looking at a very delicate, almost explosive situation where flawless fundamental business performance is just colliding head on with market psychology.
Right, market psychology, momentum trading, and frankly, some impossibly high expectations. Welcome to the deep dive, everyone. We are thrilled to have you with us today.
Absolutely. Glad you're here.
Our mission for this session is to completely unpack the latest data on Taiwan Semiconductor Manufacturing Company, or, universally known as TSM.
The undisputed heavyweight.
Exactly.
Yeah.
Today, we're dissecting their Q1 2026 numbers to figure out if the stock is staging a historic breakout or if it's setting up the everyday investor for a major fall.
We've got a whole stack of sources today. We're detailing their income statements, the current technical order flow, the latest analyst ratings, and of course, those underlying geopolitical risks.
But before we get deep into the weeds on these charts, if you're finding this breakdown helpful, please hit that like button, subscribe to our YouTube channel, and definitely drop your thoughts and compulsory feedback in the comments.
We really want to know exactly where you stand on this debate.
Yeah.
But as always, before we dive into the numbers and the projections, I need to provide a clear baseline for our discussion.
Go for it.
The conversation we are having today is strictly an educational debate of the provided sources, analyst notes, and market data. This deep dive is absolutely not financial advice.
Not at all.
We're just here to analyze the information, connect the dots, and help you understand the broader landscape. But, any investment decision should be made entirely with your own research and your personal risk tolerance in mind.
Perfectly said. Okay, let's unpack this. We have to start by grounding ourselves in the immediate reality of what the stock is actually doing today.
Right, let's look at the tape.
So I'm looking at the snapshot, and TSM is currently trading at $366.55. It's up 0.91% for the day, which honestly doesn't seem like a massive jump. But here is the context that really matters. It's sitting agonizingly close to its 52-week high.
Yeah, that high is sitting at $390.21. It's right there.
It is hovering in that exact territory where traders are just watching like hawks, trying to see if it finally breaks through that ceiling or if it gets violently rejected and tumbles down.
And what's fascinating here is understanding the sheer force that drove the stock up into this neighborhood in the first place.
Right. Because this isn't a meme stock.
Exactly. This isn't just a speculative bubble built on, empty promises.
Yeah.
It's anchored in their Q1 2026 earnings, which were, by pretty much every traditional metric, staggering.
Unbelievable numbers.
When you look at the quarterly and annual income statements, the acceleration of their underlying business is almost hard to comprehend.
Staggering is definitely the right word. Let's put some scale to this for you listening. In Q1, their revenue hit a massive NT 134.9 billion,
Which is just a colossal figure.
It really is. And if we convert that new Taiwan dollar figure to US dollars for context, we are talking about roughly $35.85 billion generated in a single quarter.
A single quarter. Let that sink in.
And that represents a massive 35.1% year-over-year increase. You just do not typically see a 35% revenue jump in a company that is already this enormous.
No, you really don't. And their net income followed suit, too. It surged to NT $572.48 billion.
Right. And if we connect this to the bigger picture, you have to ask yourself why this is happening right now.
The answer is the overwhelming, almost desperate global demand for AI-specific infrastructure.
Yeah, everybody needs these chips. But honestly, the revenue isn't even the most impressive part of the earnings report, is it?
Not at all. The most critical number, the one that absolutely defines TSM's current market dominance, is their gross margin.
Okay, yes.
They reported a gross margin of 59.5%.
I really want to pause on that because it's so easy to just hear a percentage, say, oh, that's nice, and move on. Achieving a near 60% gross margin in complex physical hardware manufacturing is almost unheard of. It's like selling water in a desert. They practically own the well.
That's a great analogy.
Usually when you see a company pulling in a 60 or 70% margin, you're looking at a pure software company. Because software is magical, right? It has almost zero marginal cost of reproduction.
You pay your developers to write the code once, and then you just sell that exact same software a million times?
Exactly, with almost zero extra cost. But TSM isn't making software. They're making highly complex physical items.
They're manufacturing the most sophisticated physical objects human beings have ever engineered.
Right.
That 59.5% margin specifically reflects their absolute manufacturing dominance in their advanced 3-nanometer and 5-nanometer chip nodes.
Which are incredibly hard to make.
Oh, completely. These components require multi-billion-dollar machines utilizing extreme ultraviolet lithography just to print microscopic patterns on silicon.
It sounds like sci-fi.
It basically is. It's incredibly difficult, highly capital-intensive work. And yet, TSM is executing this with unprecedented profitability because the entire artificial intelligence industry literally cannot function without these specific chips right now.
Companies like Apple, NVIDIA, AMD.
Exactly. TSM is the only fabricator on Earth that can produce them reliably at this kind of massive scale.
So they essentially have a legal monopoly on the world's most critical technological resource. But here is the friction for the listener who's trying to navigate the market today.
Mm-hmm.
A perfect company doesn't automatically mean the stock is a safe buy at any given second.
Very true.
Because if everyone already knows TSM has a nearly 60% margin and everyone knows AI demand is through the roof, isn't that already priced in?
That's the classic market
Well,
tone.
if the boat is too crowded on the buy side, the stock can still be a dangerous play. High margins and record revenues are great on paper, but how is that translating to the actual buying and selling in the market?
That's the million-dollar question. And it's why we have to shift our focus to the technical analysis and the order flow.
Let's do it. What are the charts telling us?
When we look at the charts, the trend direction is undeniably bullish right now. TSM is trading comfortably above its key moving averages.
Okay, break those down for us.
Sure, the 50-day moving average is acting as a sort of short-term tracker, and that's currently sitting at $354.28.
Got it.
And then the longer-term 200-day moving average, which shows the broader historical trend, is all the way down at $297.62.
So for anyone tracking the trend structure, the short-term average is miles above the long-term average, and the current price is sitting above both of them.
That is textbook bullish momentum.
But breaking new ground is never a free run. I'm looking at the resistance levels in the sources. We've got an immediate resistance at $374.59.
Right, that's the first major battleground.
And then the massive all-time high barrier is sitting right above that at $387.74, which guards that ultimate 52-week high of $390.21.
Exactly. Breaking that barrier is the dream for the bulls.
But I'm looking at this steep run-up, and I'm thinking about gravity. If buyers get exhausted right here, right at this resistance, how far down is the safety net?
We definitely have to look at the downside protection.
Are we looking at a potential free fall if it gets rejected?
Not a free fall, no. The technical floor is actually relatively well-defined right now. If the stock faces a rejection and pulls back, our first major line of defense, the immediate support level, is right at that 50-day moving average.
Which is that $354.28 level.
Exactly. There are a lot of institutional algorithms and buyers programmed to step in right at that level.
Okay, but what if that breaks?
If that floor somehow breaks due to a broader market sell-off or some bad news, the next major support zone is sitting at $344.44. So you do have distinct levels of downside protection.
That makes sense. But I'm also looking at the momentum indicators in the sources, and this is where I get a little tripped up. Let's talk about the relative strength index, the RSI.
Okay, the 14-day RSI.
Yeah. The sources say it's currently sitting at 58.51. Now, usually when a stock is rocketing up near its all-time highs like this, I expect the RSI to be absolutely screaming that the stock is overbought.
Flashing red.
Right. Like sitting up in the 70s or 80s, warning everyone that a pullback is imminent. But 58.51.
Right. An RSI of 58.51 is categorized as solidly neutral.
Yeah.
And this is a really crucial detail to understand.
Why is that?
The RSI essentially measures the speed and magnitude of recent price changes. The fact that it is at 58.51 means that, despite the recent gains, the stock has essentially digested its upward moves healthily.
Oh, interesting.
It hasn't spiked so violently in a straight line that it's mathematically stretched too thin. It implies there is still actual room for the stock to run higher before the mathematical rubber band snaps back.
Okay, so the trend is up, and the mathematical indicators like the RSI say there's still gas in the tank.
Combine that with the MCD, the moving average convergent divergence.
Right. The sources show the MACD is sitting at 7.23.
Which is well into positive territory, indicating a sustained buy signal. So the machinery looks primed.
But who is actually stepping on the gas pedal? Let's talk about the order flow, because the sources highlight some massive options activity.
Yes, the recent options flow is highly revealing of market psychology right now. We're seeing massive, heavy concentrations of call options at the $375 and, more notably, the $415 strike prices.
Wow. And for anyone newer to options, buying a tall is essentially placing a leveraged bet that the stock is going up.
Correct.
So seeing a mountain of calls at $415 means big money is betting heavily on a huge upside move.
Exactly. Institutional players or large-scale retail syndicates are willing to put serious capital on the line, betting that TSM won't just test its high of $390, but will blow right past it and establish new trading range in the $400 very soon.
That is wild.
It signals overwhelming bullish sentiment in the derivatives market. And structurally, when market makers sell those calls, they often have to buy the underlying stock to hedge their risk.
Which just creates even more upward buying pressure.
Exactly. It's a feedback loop.
Okay, but here's where it gets really interesting, but also a bit scary. I want to push back because this feels dangerous.
How so?
With the stock this close to its 52-week high and all these calls piling up, aren't retail traders at risk of buying at the exact top just because of momentum FOMO?
Oh, absolutely. Fear of missing out is a powerful drug in the market.
Right. If everyone is already standing on the exact same side of the boat, doesn't that make the boat incredibly likely to tip over at the first sign of bad news?
It does, and that is precisely why you can never look at technical momentum in a vacuum. Momentum can carry a stock incredibly far, incredibly fast, but eventually the music stops.
And fundamental reality sets in.
Exactly. If the charts and the options flow look this hot, we are forced to ask if the actual underlying business justifies this premium price tag.
Which leads us directly into the valuation tug-of-war. Is TSM genuinely undervalued given its growth, or is this a classic value trap waiting to spring on the retail trader?
Let's dig into that valuation. The analyst consensus right now is a strong buy.
A strong buy.
Okay. Yeah, they've slapped an average 12-month target price of $453 on the stock. From our current price near $366, that represents roughly a 23% upside.
So the Wall Street professionals are effectively agreeing with those aggressive $415 call option buyers.
It seems that way, yes.
But let's look at what you are actually paying for that growth. TSM's price-to-earnings ratio, the PE ratio, currently sits at 31.34.
Which is the entire core of the debate right there.
Exactly. Let's pause and really debate this multiple. A 31.34 PE means an investor is willing to pay over $31 today for every single dollar of earnings the company generates over a year.
Right.
Now, if you were a high-growth cloud software company, a 31 multiple might actually look cheap. But TSM is a hardware fabricator.
Very true.
Historically, traditional manufacturing and hardware fabrication companies trade at much, much lower multiples, maybe a 15 or 20 PE if they are lucky.
Because they are insanely capital intensive.
Exactly. They have to constantly spend billions of dollars building physical factories just to maintain their revenue. So how on earth is a 31 PE justified for a company that bends metal and prints silicon? Is it too expensive?
It's a fantastic point. And if you look at TSM strictly through the lens of a traditional 20th century manufacturer, a 31 multiple is incredibly rich.
It borders on absurd.
It does. However, the justification from the analysts who label this stock as fairly valued or even undervalued entirely hinges on the future growth projections.
Okay, what are the projections saying?
Specifically, it's the projected compound annual growth rate, the KGR, for their AI-related revenue. The estimates suggest a staggering 55 to 59% growth rate every single year through 2029.
Wait, 55 to 59% growth compounding annually for the next 4 years.
Yes, and the math of compounding is incredibly powerful.
I mean, that's astronomical.
If a company actually manages to grow its earnings at nearly 60% a year, the E in that price-to-earnings ratio explodes upward. So theoretically, if you pay a 31 multiple today and they hit those massive growth targets, in 2 years, that multiple will have drastically shrunk.
Because the earnings caught up.
Exactly. And you'll realize you actually bought the stock at a bargain. The high multiple today is essentially a down payment on exponential future profits.
But, and here is the trap risk. What does this all mean for the everyday investor? Paying a 31 PE means you are paying for years of flawless execution.
Priced for perfection.
Right. Everything has to go perfectly. If that 55% growth stutters even a little bit, say it drops to 30%, this stock becomes a massive value trap for retail investors.
Because 30% growth is phenomenal by normal standards, but it's a disaster if you're priced for 60%.
Exactly. The multiple would instantly compress, the stock price would collapse, and all those people buying $415 calls get wiped out.
Flawless execution is incredibly hard to maintain. which forces us to look at the severe risks that could derail TSM's best-case scenario.
We need to weigh the bull case against the bear case. Let's outline the best case recovery scenario and the worst case continuation lower.
All right, let's start with the bull case. It's essentially the narrative we've been discussing. It rests on their absolute, undisputed leadership in the advanced 3-nanometer nodes.
They own the bleeding edge of physics.
They do. And that technological moat has secured them highly strategic, locked-in partnerships with giants like Apple and NVIDIA.
These giants simply cannot afford to use inferior chips.
No, they can't. Furthermore, the short-term outlook is heavily bolstered by the ongoing, ravenous expansion of AI infrastructure globally. Every major tech company is currently locked in an arms race.
And there's also a very tangible near-term catalyst mentioned in our sources. The next dividend X date is coming up on June 11, 2026.
Wow, right.
For institutional investors, mutual funds, and dividend portfolios, that provides a very solid short-term incentive to hold the stock or accumulate more shares before that date.
Which serves as a near-term catalyst, adding more fuel to that bullish momentum fire we saw in the charts.
Exactly, but what about the bear case, the downside risks?
The worst-case scenario is substantial, and it's arguably not being fully priced in by the current options momentum. The most obvious, heavily discussed risk is geopolitics.
The ever-present risk of tensions in the Taiwan Strait.
Exactly. The vast majority of TSM's most advanced fabrication happens directly on the island of Taiwan. Any disruption there is an immediate, catastrophic shock to the entire global tech economy.
It's the ultimate elephant in the room.
It really is.
But there's another risk detailed in the sources that I think gets completely ignored by retail traders who are just caught up in the AI hype.
And what's that?
Margin erosion. TSM knows the geopolitical risk is a problem, so they're actively trying to mitigate it by expanding their footprint. They are building massive new fabrication plants overseas, specifically in the US and in Japan.
And this is where the financial reality heavily conflicts with the operational strategy.
Right.
Expanding into the US and Japan is punishingly expensive. The labor costs are drastically higher, the regulatory environments are stricter, and they don't have the deeply integrated, localized supply chains they spent decades perfecting in Taiwan.
So this global expansion threatens to eat directly into that beautiful 59.5% gross margin we were praising earlier.
Yes.
Let's try to visualize this for a second, because margin erosion can sound like, abstract corporate speak.
Sure, let's break it down.
Imagine you run the most successful, highly profitable local bakery in the world. You've spent 20 years perfecting the recipe. The guy who sells you flour is right next door. Your ovens are perfectly tuned to the local humidity, and your bakers know exactly how the dough should feel.
So you have a highly localized, perfectly optimized ecosystem.
Exactly. Because everything is so efficient, you make massive profits on every single loaf of bread you sell.
Okay, I'm tracking with you.
But then, to satisfy global demand and to lower the risk of your main bakery catching fire, your biggest customers force you to open a brand new bakery across the ocean in Arizona. You have to build the entire building from scratch. Suddenly, the rent is triple. The local water changes the recipe, so half your bread collapses in the oven. You have to train brand new bakers who demand higher wages, and your flour supplier doesn't even exist out there yet.
Wow, yeah.
But here's the kicker. You can't really charge your customers like Apple and NVIDIA double for the bread because they have their own strict profit margins to maintain.
So your overall corporate profit margin is going to take a major sustained hit. I think that bakery analogy hits the nail on the head, especially when you consider the concept of yield in chip manufacturing.
Explain yield for us.
It's basically the percentage of chips on a wafer that actually work. In Taiwan, TSM's yield is incredibly high because the ecosystem is perfect. When you build a new fab in Arizona, it takes years to dial in the microscopic precision required to get that yield up.
So for years, you are essentially throwing away a huge percentage of what you manufacture.
Exactly. The overseas fabrication costs are undeniably higher. It threatens to compress that currently perfect margin. As these new fabs scale up, the company's blended profit margin will inevitably blend downward.
So bringing this all together, we have a situation where the short-term indicators and the long-term structural realities are telling two very, very different stories.
Precisely. To summarize the dichotomy we are seeing in the sources, the short-term perspective is almost completely dominated by bullish momentum.
We've got strong technical bias signals, a neutral RSI with room to run,
relentless AI infrastructure spending, and an upcoming dividend catalyst. The trend is undeniably your friend right now.
But then,
The long-term perspective requires navigating an absolute minefield. You have the severe geopolitical landmines in the Taiwan Strait, combined with the harsh mathematical margin realities of their global expansion.
This stock is currently a massive battleground between current operational perfection and future geopolitical complication.
It really is.
It makes you step back and look at the whole chessboard, rather than just today's ticker price. We've seen the record earnings. We understand how the math justifies that high 31 PE multiple if they maintain perfect execution, and we see the massive AI projections.
But you simply cannot duplicate a hyper-efficient, localized ecosystem into more expensive global territories and expect the fundamental profit math to stay exactly the same.
Which leaves us with a provocative, lingering thought for you to ponder long after this deep dive is over.
What's the final thought?
If the unstoppable wave of global AI demand absolutely requires TSM to expand its manufacturing footprint worldwide, but that exact global expansion slowly destroys the 59.5% profit margins that make the stock so incredibly attractive to investors today, who actually wins in the end?
That is a very important multi-billion-dollar question to consider.
Thank you so much for joining us on this deep dive. We really appreciate you spending your time with us to navigate these complex waters and look past the surface level hype.
It's been a great discussion.
Just a quick reminder, if you enjoyed this analysis, please like the video, subscribe to our YouTube channel, and drop your thoughts and compulsory feedback in the comments below.
We want to hear your take on the TSM dilemma. Are you bullish on the AI supercycle or worried about the valuation trap?
Exactly. Until next time, take care.